Now I think we can start. Thank you once again, everyone, for joining our webinar, which is going on live from Cannes, live from MIPIM. It is absolute privilege to be here, and it's absolute privilege to know that a lot of people are interested in our outlook on the current situation in the UAE and the Dubai office market in particular. It's definitely very hard to find a quiet spot here during the big forum, big international forum. So if somebody's walking and talking behind me, I do apologize. So let's start. Let's start with the basics that we currently are looking at and where we currently are at. And so we see a strong banking perspective. So that's one of the few macroeconomic elements that we wanted to highlight today. So we see a year-on-year growth of a loan portfolio to private individuals, to businesses, in terms of the personal loans and mortgages. So it's on a 10% year-on-year, which is fantastic achievement for the UAE banking system. It remains robust due to the population growth, of course, because Dubai itself reached 4 million people not that long ago, and they have a very big plan on increasing this number even higher in the upcoming 5 years. So thus we see a big inflow of the deposits to the local banking system, even reaching 3 trillion dirhams, in which equals to a rise of over 15% year on year for the residents. And even the non-residents continue to inflow the money to the UAE banking system due to its stability and due to easiness of the process. Also the inflation forecast remains very low at 2%, which is highlighted by the central bank and the International Monetary Fund as well. Moving on forwards, we can highlight also that the projected GDP growth of the UAE is 5%, and it remains the same in 2026 and 2025. And this is an unbiased opinion of the World Bank, which gives us quite a serious assurance that the stability of the economic elements in the UAE is there. So also the non-oil sector and oil sectors are due to rise as well. But because of this high rising and the booming economy, we still are balancing with the introduction of the 9% corporate tax in 2025. Thus, that gives us another instrument to how to diverge from the oil price volatility and the income of the country from the oil industry, which is one of the few very big anchors of the local rulers and local economy to do so. I was amazed to find out that 1.4 million companies are established in the UAE, and in 2025 alone, 250,000 companies have been established in the UAE, in free zones and in mainland, which is a sign of a fantastic business climate, which is bringing a lot of international companies to the UAE. Of course, this economic stability and economic growth can't be without any potential risk, which we wanted to highlight today. And of course, it's all over news, and all the residents of Dubai and the UAE know this for a fact. And we are going to highlight them in our webinar today. So, of course, geopolitical tensions are there, and I'm gonna highlight it in the next slide, which brings us to oil price volatility risk, and as well, if we're speaking about commercial real estate and real estate in general, that's potential correction of the uptrend that has been happening for the last 5 years, and has been with us and gave us big opportunities on the local market. We see that foreign direct investment is driven by long-term fundamentals, first of all, and we don't see that the short-term market pauses can make a big impact on the local economic uptrend. So thus, the stability of the transparency of the regulations, the tax frameworks, and the easiness of the market access can get us can take us high. And we absolutely understand that long-term investors and the institutional developers and institutional investors don't think short-term. So they see the bigger picture, and they see that the joint ventures are possible, and that there won't be a problem in a big scale in the long term, even though potential risks are still there. We can highlight several points which should be covered due to the Gulf crisis of March 2026, and in particular the conflict with Iran and its impact on the global economy. Speaking about that, we can say that a short escalation of the conflict will bring the oil prices to around $70-$85 per barrel, and that will take us to a limited macro impact. But the prolonged conflict, which will be over 2 or 3 months and above, that raises the quite a big risk and risk to the stability. However, that's very far off now, and that's one of the points that's worth discussing and it's worth highlighting only. We see that the potential inflation risk is there also due to, once again, oil prices rise, as well as we feel that the sector divergence can be increased because such industries as energy, defense, and infrastructure, banking system, and all of that can outperform. However, due to the limitations of the economy and the current political situation, the airlines, chemicals, energy sectors, and maybe even like the hospitality industry may suffer a bit and face pressure. However, we see that the market faces asymmetric risks, so that the volatility will be contained, and the corrections will be limited. Of course, in the short term, speaking about that. If we say about the energy as one of the key drivers of the regional economy and the global scale potential tensions, we see that the disruptions of the strait, which has been blocked by Iran, they may cause quite a big impact, especially on the stress of the market. So that's why we see a big hike in the oil prices as we speak. However, we don't feel that this will be a long-term solution and a long-term risk. So these are quite a few points to discuss and to highlight. If we come back to Dubai office market, the ones that we are represented in, the ones that we are active part of, as a snapshot, we can see that the vacancy is same old, it's close to zero, especially in the prime office segment and the grade A. The yearly rents are on the rise 20% year on year, reaching to 210 dirhams per square foot on average in the city scale. Of course, as we will see in the following up slides, that this is a very basic and very average number. So this very well depends on the area, on the current supply in specific zones, and even in specific buildings. However, in general, the office market of the UAE remains a global hub and a global, connectivity platform for all the businesses, and not only Dubai offices, but also the Abu Dhabi. This is a very big opportunity for the global businesses to open headquarters and develop their business in the Emirates. So all of that happens due to the business-friendly regulatory and tax environment, easiness to the access of the global talent, because, well, we have to be fair, all the brightest and all the global talent are here. Strong connectivity to the worldwide, because it's also a strategic time zone bridging East and the West. So even, it's convenient to take calls with the US and with Asia together, you can always find time during the day. The system becomes more and more mature, of course. It's still ongoing its development. However, we see with the, for example, graphs below that on the global scale, office rents in Dubai and Abu Dhabi, as well as the vacancy level, are not only at all-time high for the UAE, but also on the global scale. That's among the top cities all over the world, which gives us a status of the real worldwide hub. Of course, everybody's speaking about the new office supply that's coming up to the market by 2030, and that will wash out the rents and will put them down. But we have to be transparent here, and we have to be smart about that. And we need to see the actual statistics on where exactly this new office supply is coming, and what kind of quality and what kind of assets are those. Now, we can say that two-thirds of the upcoming pipeline is single-owned, and it's an important distinction because of the stability of the clients which come to these buildings, because we have to be transparent that global companies and the best of the market won't go to some you know not obvious strata-owned buildings. They want to be a part of a whole community owned by institutional investors or even state entities. So that's why we see that the DIFC is the largest, has the largest share of the new completions. And unlike many new office buildings coming up to the market, they will fully own what's coming up, and they will only lease it. So that gives a future potential tenants and users of those office spaces the stability of the rents, stability of the market perception, and stability of services that they're paying for, and the location, of course. Because we feel and we see in practice that there's been a prolonged supply crunch as well. Large proportion of the future office supply can be and will be definitely committed way ahead of the completion. We see that contracts are being signed for the start of rent like in a year from now, because of the very few buildings coming up in the targeted areas or the targeted office quality for the future clients. That's why they want to pre-commit, and also because of that they're able to commit on a better pricing. And we can see from the graph on the right that the upcoming office supply by area is very well dispersed, and it's 50% is coming up in free zones, around 16% coming up in dual licensed places, and the rest is coming up in mainland. And as we can see from the areas for the new office supply, that's very, very dispersed offering. So that's why we can't say that, all like millions of square feet are coming up in one area, thus the rents will go down. No, we feel absolutely different trend. That's because of the different areas and the different level of quality of buildings coming up in the market. They still will find their users, and they still will keep the rents hiking as we see now. Yeah, we see that the trends for the occupiers are these, because it comes up coming up increasingly challenging for the companies to find large scale offices, not only for the serviced office operators like ourselves or our colleagues on the market, but end users even. They are either deferring expansions to like a year from now or 2 years from now, because they would rather sit in their existing office and not move anywhere, not to lose this opportunity. Or they're expanding, their new business branches or new people or new business lines to the flex office workspace, which we're going to discuss later on. Or they're relocating to emerging office districts. We work a lot, and we're big friends with a lot of such zones, which are appearing and will be major developments in Dubai, such as Expo City, Dubai Commerce City, Dubai South. They are raising a lot of attention. First of all, with convenient rent pricing, good quality, and even though the locations are not central business, they are doing everything they can to feel it as a hub, as which is welcoming the global occupiers. Key strategies for managing costs and availability by occupiers in such current office market situation will be the early lease renewals, pre-commitments for the future developments, and relocating to emerging business districts. Speaking about the investors and developers, we see the big pressure for the exponentially rising land costs and construction costs. Thus, only the premium premium on only the highest class possible of office projects are feasible to build, and especially in the central business districts of the Emirates. Thus, there are elevated entry prices for the end users, and to leave some of the yield for the investor. Otherwise, it just doesn't work. So for investors and developers are seeing a very big pressure currently in the situation. Speaking about rents, I wanted to highlight the prime office segment. Of course, the IFC remains at the top of its game, because only 5 buildings throughout the IFC are owned by private individuals or institutional funds. The rest is owned by the IFC directly, and thus we have a big dispersion of the rates throughout the AFC, but still on average, they achieve a very high price tag on the market, which is 600 dirhams per square foot per year. Following up is a very big highlight is One Central as a prime office park, due to its continuing development of infrastructure and absolute lack of not only shell and core units, but availability of units in particular, because all the clients tend to prolong to be in One Central. Any single availability coming up pushes the rents higher and higher all the time. Same goes for downtown, because no new developments are coming up in downtown in particular, close to Dubai Mall, Burj Khalifa. So that's why the continued upward trend of pressure for the office rents to go up happens. As a couple of other trends, we see that due to the lack of the new supply and the lack of current availability on the market, especially in those three areas in Dubai, there are no options for shell and core left. Thus, the companies have to get the lease of option A1 is the fitted out offices from the previous tenants and refurbish them. B is go to the serviced office operators, which we're going to talk about a bit later on. So some offices were leased by long-term clients and they're being vacated. That stuff happens, but they were leased at very lower rents. So now when they're coming up available on the market, new tenants have to catch them in a double the price, because they have to landlords have to adapt to the current lease rates. Thus, the average number of rent rates on the market always constantly quarter on quarter pushes up and up and up all the time, because of the old stock coming up back to the market. Yeah, landlords lease offices with existing fit out. That's the lease out to the market. Thus, the elevated rates are there, and on that basis, new flex office operators appear, and they include like ourselves, for example, and our colleagues on the market. But we include the service into the pricing, the fit out. Of course, we enter the market at a higher rents, which are accessible now on the market. And the average rent price of our business is calculated with all of that in mind. Thus, the average rate rent in the city is also elevated. This graph shows the whole situation on the current market. Our friends from Cushman Wakefield report published this graph, and that represents very well the trends which are existing on the current market. So we can see that non-obvious, business locations as Dubai Investment Park, for example, Dubai South, which is emerging now. They have a very high year-on-year change of the rent rate. It's purely due to the lack of the availability, and such complexes as, for example, D3, they have a huge list of companies interested in their spaces, but they're only starting to build new expansions. But now there's zero availability, which of course pushes the rents up. We have to highlight flex office market trends because, of course, it's everywhere. And I also wanted to highlight like the prerequisites of it appearing, because it's pure according to our own experience of 4 years being on the market. So we see that the companies want to have a prestigious address, prestigious building, and of course, end users do want that, and they're already there. Thus, no new offices are coming up available in those districts or buildings. But some serviced office operators like ourselves are lucky to be located within such districts. Thus, uh, we attract, we as flex office operators, we attract top companies to the top locations. Of course, this kind of prime segment will always be there. In terms of cost predictability, the bundled services remove the need for major upfront capital outlays, which definitely gives the upside for the companies to enter such offices. In terms of the speed to market, also the immediate occupancy without waiting on construction and fit outs is given as an opportunity by flex office operators. We see that the staff, also the companies of small to medium scale, they don't want to overspend on hiring. They want to use facilities, use services, use flex office operator staff even for some of the services, and that gives the end users the single window of opportunity and a lot of additional value to their office, not just a desk and a chair, in terms of the also that we can say that traditional leases are not being replaced by the flex office operators. They're being complemented because, as we saw previously, even the big global occupiers they introduced the hybrid portfolio to their office segment, and we talk a lot to the global companies, global occupiers who want this in their portfolio, and this can't be overlooked. Thus, we divide the market a bit to the smaller micro units and the serviced offices, which are over 1,000 square feet, like on average. We can say that in the prime segment for the micro offices, which are priced by desk per month. The pricing is achieved at 3,000, 5,000 dirhams per desk per month in the prime segment. Class A, 2,300 to 3,000 approximately dirhams per desk per month. And the Class B is roughly 1,500 to 2,300 dirhams per desk per month. If we're speaking about the serviced offices, which are over 1,000 square feet, we see that the achievable prime rates are from 900 to 1,400 dirhams per square foot per year, because they're priced a bit differently, and putting up the rate per desk in such a serviced office environment will not be fair, and will a bit divert the attention to the final amount of money payable by the end user. In terms of the Class A, that's 500 to 800 dirhams per square foot per year, and the Class B achieves 200, 350 dirhams per square foot. If we speak about flex office operators, where the service charge, utilities, internet cleaning, and furniture, IT component, everything is included into the pricing. In this trend, we can say that Ispace has been quite successful, because phase one that we did are the micro offices, and we achieve a very big price escalation in accordance with the market trends. And we have been full, for quite a while now, and the current clients tend to prolong, no matter the current situation and no matter what happens currently in the global stressful times, because we see that the client wants to stay at the best possible office park. They want to stay with a stable operator. They still want to be in the regional, be part of the regional economy, and we don't see any stressful decisions being made by the clients, which is absolutely phenomenal to see. Phase two was the build to suit, one of the very, very, very few build to suits done on the market. So we have gained a very big experience in dealing with construction from shell and core to one client and to servicing this office. And the phase three as executive offices has also been 100% leased during the construction times and up to now, and will be. So we feel like all of the three models work, and all of the three models find their own audience. and we actively promote that the clients need to ask for, more quality service, and the whole market of the flex office operators will elevate, and we will lead this process. Let's finish up with the highlights of MIPIM 2026, because of course the whole global real estate arena is currently being represented here in Cannes. But still, the European stands and global stands, exhibition halls are eyeing a MENA region first of all. We see that the attention to Saudi's projects is very high. Their meetings are fully booked, so you can barely get a seat at the table in investors' dinners. But we're lucky to be friends with them, so we got a couple. But still, we feel like the global economy still looks at this region as a window of opportunity of growth, because speaking to different colleagues and different partners from all over the world, we feel that that things are quite stressful and have been for a while, and with all the global stress currently on the market, the stress is not going anywhere. Also, we see that everybody's trying to use as much tech as possible to optimize real estate assets. Everybody's speaking how AI can help in commercial real estate administration, and because the cuts of the employee base is there, and we feel that the tech is one of the key drivers of the market optimization currently. And also the European market, from what we've seen, we've talked to different stands, to different countries, we saw that very high for the local market interest rates are causing a lot of stress and in real estate currently, and the new constructions are very scarce, and that the budget cuts of end users who will be leasing those offices or those warehouses also doesn't help to the construction and the developer business. However, in Europe, let's say that we see that, and we spoke to a lot of people, that Polish market is there on the rise, and it's a current driver of the European real estate. And it's great to see that such islands of activity are there. And let's see where it takes us, and let's see how it goes. Thank you so much. Thank you so much for being with us today. If there are any questions, I would love to answer them. Let's wait. Maybe somebody has questions. Hope that the disturbance of the people around me wasn't too much. Yeah, our presentation has been quite profound, so I hope that a lot of questions has been answered. And thank you so much once again for being here today with us, and for joining and seeing the palms and the Palai, the festival. And it's great to share our experience and our knowledge, and saying hi to all of our friends and partners and colleagues in the UAE. And see you shortly.